Howdy there, folks. Welcome into today's video. Two videos for me to react to in this one. First one up here, Cathie Wood. Cathie Wood on Bloomberg just a few hours ago speaking about stocks, her strategy, Tesla, many other subjects. So I want to react to what Cathie Wood has to say in regards to those subjects. Then I want to go ahead and react to this one from a couple hours ago. So, a pretty big name when it comes to Wall Street analysts just raised their S&P 500 price target considerably from 4,300 to now 4,600, which I want to hear why she's going ahead and doing this, because that's a big raise at year end, and it almost looks like Wall Street's kind of tripping over themselves now at this point in time to make some moves. So I want to get straight into this. I appreciate everybody joining me as always. Thank you so much for being subscribed, folks. We are now at a new all-time high subscribers, so I appreciate each and every one of you for always being here. Got a free workshop for you guys that will be pinned comment.
With all you've been through the last number of years, are you going to shift to a more long-term strategy? I look at Morningstar, 1 year, 3 year, 5 year, your bottom quartile, but your claim is more short-term. With your new ETF effort and with what you're doing with ARK, are you going to be still on trend, or do you invest more for long-term?
Wait, whoa. I was not expecting the interview to start like that. This man's just basically saying you're a short-term trader. And are you going to focus more long-term? And Cathie Wood, this is shocking. What a way to start this interview. I'm interested to hear how she handles this, because she's supposed to be, long-term, looking out long-term. Oh my gosh, what?
We've always invested for the long term. And what interrupted what was a very nice move up in innovation stocks, especially disruptive innovation, was a massive increase in interest rates, the likes of which we have never seen.
Of course.
24-fold increase. So all long duration assets, especially in 2022, were destroyed, including bonds, which are usually a flight to safety. They had their worst year last year since the 1700s. There's no way in that environment that our strategy would have done well. But I do think that what's happening this year is that the market is starting to look over the Fed's moves, whether there's one more or not, into falling interest rates. We started underperforming in 21 just with the anticipation of rising rates, and even more so in 22.
So how are you going to change? I want to know how you're going to change the sobering quarters you've been through. What is the new Cathie Wood approach to macroeconomics, frankly, pandemic economics, intruding on your belief in innovation?
If anything, innovation gains traction during tough times. And if you look at how the reason...
Yeah, I'm telling you, man, those are two brutal questions. First off, he's asking, are you even long-term, okay? And basically saying she's a short-term trader. Then he stops and basically in this next question, oh my gosh. Then he's going ahead and saying, what have you learned? How are you going to approach the market moving forward? What strategy you're going to adapt now? Because you haven't been doing well. Whoa, okay.
Our portfolios are outperforming this year it is because they are gaining share in what is becoming a difficult environment, right? And so one by one, we're going to earn our way back, and it's all about revenue growth, margin expansion.
That's not that, considering how maybe on the riskier side she invests, that's not that great. She might be barely beating the Qs this year. The public count's killing her returns this year. I think we're over a double up of that. So, I don't know. For how bad last year was, you need to have even a much bigger bounce back year, in my opinion, than what she's having this year.
Wall Street Journal, they do a fabulous thing with old farts like me and his people.
But this is brutal, man. Those were two brutal questions in a row. This guy definitely didn't come in to kiss Cathie Wood's butt in regards to this situation. Holy smokes.
With over $5 million, and they believed in Cathie Wood. To a person, those retirees bought innovation, they bought tech, they bought Apple, and they didn't listen to financial TV or radio. Can you do the Cathie Wood approach for 1, 3, 5 years, given the volatility you've seen?
Yes, I think we're on the other side of that massive interest rate increase, which did destroy a lot of performance. That's the most important thing. And We are ready for prime time. Many people are concerned about our kind of strategy, and the company we just acquired, Rises, because in Europe, in London here, for all of Europe and UK, they're focused on global mega trends as well. And, interest rates hurt everyone in that space. If we are right, and rates are going to come down at some point in the next year, the market is a discounting mechanism, then I think that the muscle memory that hurt our strategy, and it all has everything to do with the tech and telecom bust, and people thinking, oh my gosh, are we here again? No. What happened during the 20 years that ended in the tech and telecom bubble is the seeds for what is happening now were planted.
Yeah. And this, John, is really important, and that the profitability stream down the income statement of new tech is very different than 2000 tech.
Let's talk about EVs.
Yes.
And not just Tesla.
Yes.
Is it good news for Tesla what's happening in Detroit right now?
Yes, because if there's a strike, of course, there will be more production shortfalls.
That's not the best thing going on for Tesla. I'm interested to hear how Cathie Wood handles this. Do you want to know what truly is the best thing going for Tesla right now? Like literally today, okay? I'll tell you what it is. The fact that you have to pay $6 plus a gallon for gas in LA right now, and much of the country's $4 plus right now, that's way bigger than any auto strike in Detroit, okay? That's almost completely irrelevant. The fact that everybody's getting absolutely bent over when it comes to freaking gas prices right now, 2 years in a row, and people aren't going to forget this, folks. Believe me, that's the best thing ever for Tesla, because every single person is thinking, dang, man, an EV for my next vehicle sounds a lot better. It would be so much cheaper to just charge at home than have to go to this gas station and pay $4, $5, $6 a gallon and spend $100, $200 a week or whatever, right? So that's actually the best thing going on for Tesla that I don't think nearly enough people are talking about.
I think that there's just now the supply chain has freed up, so unfortunately we'll have all kinds of questions about that. But I don't think it has anything really to do with the strike. It has everything to do with a consumer preference shift towards better vehicles, electric, that are falling in price. Tesla is leading that price decline simply by passing cost declines on to its customers. So I think that's what's good for Tesla.
The complaint we hear is that people can't afford these vehicles.
What we're seeing in the news changing.
In the UK, as you can see, Rishi Sunak is pushing back targets to get rid of all of these internal combustion engines to 2035 from 2030. Are we being unrealistic about this transition and how difficult this is going to be?
No, we do not think so. We actually, the total cost of ownership, now this is in the United States, it's a little bit different here, but the total cost of ownership of an electric vehicle fell below that of a gas-powered vehicle about 2 to 3 years ago. Soon, sticker prices.
Does that include insurance?
Yes, includes insurance. Yes, as I said, local differences, but yes, in the United States, that does include insurance. And in fact, Tesla is so sure that its cars will have fewer accidents and fewer fatalities that it's willing to provide insurance. So, yes, that...
Damn, man, all these years later, and these guys still haven't done enough research on Tesla. Like, the fact that you even ask a question like about insurance, it just shows me like completely clueless in regards to stock and completely clueless around EVs and everything like that. Like if you're an insurance company, if anything, you'd much rather insure a $50,000 Tesla versus a $50,000 internal combustion engine vehicle any day of the week. The technology on Tesla is leaps and bounds better than an internal combustion engine when it comes to safety features, and it's not even close. Not even remotely close, okay? On a Tesla, you got cameras all over that vehicle alerting you to anything, right? You obviously have, autopilot and all the other programs Tesla has. I mean, it's like a night and day. It's, gosh, man, like that just shows me like they still haven't done research. It amazes me all these years later.
Does include everything, all in.
You were at USC. You didn't get a B. Lefebvre called up Robert Kirby at Capital Group and said, just shut up and hire her. So you walk into Capital Group, which is the land of an R-squared and 98 Washington Mutual Fund Investment Company of America. Yes. Everything is completely diversified out. You're the polar extreme. They threw you out. You almost fell into the Pacific Ocean. They were so upset with you. So you go out and you say, I'm I'm not going tight R squared to SPX. I'm going out and do my own thing.
Yes.
People have prospered off of innovation and technology. How does that continue in America? Can you be less diversified and win 5 years out?
Well, you mentioned Capital Group, and that is where I did start my career, and that is where...
Let me hold your horses. Hold your horses for just a moment, okay? Whoa. So this gentleman's making it sound like Cathie Wood's not diversified. That's almost the way he's making it, like concentrated bets. Let's be very clear. You look at Cathie Wood's ARK ETF, and her other ETFs as well. They're actually very diversified. She can't even have a position be more than 10% of size. Like, you know, if she has to sell off Tesla all the time, because sometimes it becomes too big of a weight in there. And you look at how many stocks she holds, it's a lot of stocks, man. So just because you don't hold 500 stocks like the S&P 500 does not mean, I'll tell you, Warren Buffett, way less diversified than Cathie Wood when it comes to stock portfolio. Look at Berkshire Hathaway's stock portfolio. Over 50% of the capital is in one stock, Apple. Okay, one stock. So, that was just a poor point in my personal opinion. She's actually extremely diversified. Doesn't mean those are necessarily good stocks she holds, but she is very diversified.
I saw tremendous research and a long-term time horizon. So really what we're doing with ARK is just going back to the future. My initial experience, which was in the late 70s when I was in college, and we're doing deep research, first principles based, white sheet of paper.
But you're away from an R squared like Washington Mutual or the other funds. What's your R squared right now?
To be honest, the correlation of our performance to broad-based benchmarks is very low. For better or worse, what it tells our clients and prospective clients is we have a very good diversification strategy. Our funds, the active weight, if you're comparing to MSCI World or S&P or NASDAQ, the active weight is less than 5%. So really good diversification strategy, focused on companies that are going to transform the way the world works. We look at the broad-based benchmarks, and sure, there are companies that are sustaining innovation like an Apple, but they are not going to transform the way the world works from here. Our companies are.
Okay, so let me go ahead and pause this, and before we get into this video, I want to pull up Cathie Wood's current portfolio and kind of give my opinion on some of the biggest positions in that portfolio, because I actually haven't looked very recently here. Alrighty, folks, I pulled up Cathie Wood's portfolio here. What is my opinion of this? Well, first off, her biggest positions, Tesla, doesn't come as a surprise. Her and I have always definitely seen eye to eye on Tesla over many, many years. I remember listening to Cathie Wood speak about this stock way back in, probably 2018, 2019, and definitely always agreed with her in regards to that one. So no objection. Coinbase, I don't own it, but it's actually, I think, in a decent position. Crypto is obviously going to remain around, and obviously it's not the most exciting time for crypto right now, but let's just be honest, most of Coinbase's biggest possible competitive threats all went under last year. And so that bodes very well for Coinbase long term, right? Roku, never liked this one, never liked that one. UiPath, don't have a strong opinion, did a little research on the company, don't have a strong opinion. Zoom, I think, is okay now at this point in time. I think the main big downside in Zoom's over at this point in time. I think it could be a decent stock. DraftKings, I'm going to have to take a deeper look at DraftKings. It seems like their marketing and their position is pretty good in the marketplace, but it seems like when it comes to DraftKings, it seems like their income statement's been a mess over time. So I have to retake a look there. Exact Sciences, no opinion, not stock I track. This is Block. I think Block, most of the downside's done in Block now at this point in time. I think there's, if anything, upside potential in Block over this next couple years. Shopify, same thing, obviously, with PayPal. Shopify, I really like Shopify over the next decade, pretty much. I think Shopify's in a great position. I think they're going to continue to do well. Twilio's a decent stock now at this point in time. I think it's gotten most of the bad stuff out of the way. Teladoc, same exact kind of situation. Unity is going through a mess here in the short term. So, and those are most of her biggest positions. Everything else is pretty much a 2% position or under. But overall, if I look at her portfolio, I believe most of these stocks have already bottomed either last year or the beginning of this year. I believe most of them are going to be on an uptrend now. I think some of them are going to do pretty well, as in outperform the S&P 500. I think some of them will kind of be in that market perform area. I don't think there's anything in there that I necessarily love, but yeah, I wouldn't be surprised if our fund actually performs pretty well over this next, let's just call it 3 years. Obviously, if there's some sort of crash scenario or something like that, all the stocks will fall, but still want the S&P 500 in that sort of scenario. But overall, I got to say, I definitely like her positioning now, and certainly more than I did 2 years ago or something like that. So a lot of these stocks have already bottomed. Alrighty, let's go ahead and get into this next one. BofA Securities. I want to hear why she just massively raised her price target.
500 price target to 4,600 from 4,300. Joining us now is Savita Subramanian, head of U.S. equity and quantitative strategy at BofA Securities. Are you required to have price targets at your shop at BofA?
I don't know if it was written into my contract, but I feel like it's something we're all expected to do.
When do you do them?
So yeah, it's a great question. We do them, well, we're right about to start thinking about next year. So we usually launch our year ahead outlook in November, and then we have the luxury of being able to revise it as the year progresses. But it's kind of a silly number, right?
So it's basically, this is the last time likely she'll update this year's price target. So I think that's important for everybody to understand, because November they're going to release 2024 expectations. So she's basically going to be stuck with this 4,600 price target through the end of the year.
Impossible to do. But
it's going to be wrong.
It says you're obviously it's at 4,450 and you were at 4,300. So you need to raise it at this point. But you're 4,300. When was that from November?
No.
When did you go to 43?
Let me think about.
Okay, so that's a great point he just brings up there, right? He's basically saying you needed to bring up your price target because you're way below what the obviously the market's at right now. So you needed to bring that up, right? Interesting.
Were you dragged kicking and screaming to 4,300 too?
No. We started the year more constructive on stocks. We raised it once during the year to catch up with kind of like the Magnificent Seven rally in the first half.
Where had you been?
Oh, gosh, I'm trying to remember. I don't want to give you the wrong number, but it was, we were at every point.
You were at 3,600 by the end of the year.
No, we were not looking for 3,600.
You were somewhere above 4,000?
We were above where the market was trading at the end of the year for this year.
Okay,
so we were expecting a positive return.
I wouldn't be surprised if it was like 3,950 or like, 4,100 or something like that. I wouldn't be surprised at all.
But we didn't estimate the strength of mega cap tech. So that was our fail this year.
So now to get to, let's just assume that 4,600 is what you see as fair value. It might be a good idea to stay at 4,300 if something goes wrong, if there's a recession, this is a choice you're making.
This is a choice. This is a very concerted choice because I see far more bullish indicators for mid and large cap stocks than I do bearish. And what I think is interesting is that every day a new bearish narrative emerges. And I think that there are at least 5 reasons that you should be in stocks and mid cap stocks and large cap US stocks rather than bonds or other asset classes.
Right.
And I'll give them to you right now. One is productivity. I think that has this AI theme is not just about AI and 7 tech companies. It's about a broader efficiency driven earnings power for the S&P 500 that we haven't seen in a very long time.
Good for companies, but good for workers?
It is good for workers because think about it. Right now, we also have this mini manufacturing renaissance going on in the U.S. We've spent 10 years woefully underinvesting in manufacturing. But think about the grid, the infrastructure, all the spend that we need to support this AI boom that everybody's talking about. That's stuff on the ground that is bullish for industrials. It's bullish for machinery. It's bullish for oil. Even getting to net zero and decarbonization goals are very bullish for commodities along the way. So I think we're in an environment where we're all underestimating the bullish themes for the economy, for the stock market, and we're just focused on the fact that you can get 5% on cash.
So that's productivity.
Who cares?
You have 4 more?
I have 4 more, and I hope I remember them all. And I hope.
Okay, before she goes four more into this video here, okay? I hear so much. A lot of these Wall Streeters now starting to talk about productivity. Obviously, even Cathie Wood spoke about productivity before. Okay, I think it's important everybody understands that we've been in a productivity boom for the past several thousand years now at this point in time as humans. Okay, it's also very important for everybody to understand we've been on a major productivity boom with the age of the computer starting in the 1980s and the internet in the 1990s and then mobile devices in the 2000s. All that's helped immensely when it comes to productivity. So AI certainly will help kind of the next level of productivity, but let's not fool ourselves. Imagine your life and how less productive. Well, actually, I could make an argument that with TikTok and Instagram and all this stuff, people might be more productive without technology. So I don't even know if I want to make that point. But nonetheless, folks, every single person, because of their jobs, has to use computers and all these things that, just to be honest, it was much more complicated back in the day. I mean, imagine doing the financing for a big business back in the 1970s versus nowadays, right? Imagine banks and how hard operations were for a bank back in the 1970s versus nowadays, right? You could just say 50 years later, 1973 versus 2023, right? That's just crazy to think about. I mean, banks back in the day, back in the day, they used to have to try to keep like a piece of paper to try to figure out how much money you got. It's just crazy to think about way back in the day versus nowadays, right? It's like night and day difference. So it's important to understand we've been on a productivity boom for the last several thousand years, and we're still on that boom.
You might have a Rick Perry moment.
I know, you're never supposed to enumerate. Yeah.
Energy.
So there's a few more. One is sentiment. Sentiment is still very negative on equities, except for these mega cap tech companies. That's where the bullish arguments that I hear from clients are. Everything else is kind of neglected. I think what's interesting is that the Magnificent Seven now takes up over 40% in almost every fund manager's portfolio.
How much of a risk is that for the broad?
Oh, wait, before we go further here, I a little disagree with her. I don't think sentiment is very bearish right now. I think sentiment is more neutral for the most part, which is very different than going into this year. When you started the beginning of this year, let's be very, very, very clear. The sentiment was overwhelmingly bearish. Now I feel we're in a very neutral place overall. So not bullish, not bearish.
Markets, though, if that was the the thing you got wrong about this year, about those being so strong.
Those being strong.
What if those turn around? That's going to surprise everybody.
So I think what's interesting is that those companies, we've got 6 out of 7 of those companies we have buy ratings on. These are fundamentally attractive companies, according to the experts, our fundamental analysts. These are companies that make money and they can return cash if they don't have as much growth. I think what we saw with Meta at the beginning of the year was a really bullish sign for S&P 500 duration risk. Because what I was worried about is that a lot of the growth that you're buying in tech stocks is back-end loaded, and they're going to get hurt by a rising discount rate. What Meta did was they cut a bunch of costs, they fired a bunch of people, they did a huge buyback and pulled a lot of cash forward and returned it to investors. And I think that's the saving grace of stocks, is that companies have options. They can navigate.
So they responded to the changing market.
They responded to a change in macro, exactly. And I think...
Yeah, so Meta sets up very well for obviously the next several years, but short term, I don't think anybody has any clue the type of EPS growth this company's about to post up this coming quarter, which will be announced, probably end of October, beginning of November. And then the oh my gosh, the December quarter, which will be announced probably end of January or beginning of February at some point in time. Holy smokers, that's no joke. Wait to see the year-over-year EPS growth for Meta. That's going to be shocking. I don't think anybody's really anticipating the type of numbers Meta's going to put up this next few quarters here. So, ooh, man, am I a very happy shareholder of Meta.
That's what's really...
It's the biggest position in the public portfolio for a reason.
exciting about corporate America is that they're adapting. They're spending on automation in the face of higher inflation. So we have this tight labor market. We have an aging population, but now companies get it. And they're like, okay, we need to.
You also have strength from unions, though, too. UAW and the strikes.
UAW
that's the flexibility.
So this is the negative headline that everybody's focused on. But what this actually says and points to is an underlying shift from just financial asset inflation that benefited luxury goods and markets and, bonds and every asset class in real estate to an environment where we're seeing a broadening of income, which is actually bullish for the cyclical companies in the S&P 500. The consumer discretionary sector in the S&P 500 is much more geared to middle income spend than to luxury. Luxury is Europe. Those stocks have done really well. Now come back to the U.S. and buy some middle income spend because real wage growth just inflected positive. People are making money. Manufacturing drives jobs. I mean, I feel like I sound a little bit like a politician, but I do think that there are a lot of really positive themes right now
got the music
for the
on
broader
already.
market beyond just AI and the magnificent.
What'd you do? 4? How many did you do? You do all of them?
Have I done all of them? I feel like there were
You forgot the energy department.
neglected. What's that?
No.
I forgot energy.
The energy department. You're closing that one down, too.
I do like energy stocks, by the way, but
Yeah, who doesn't like energy stocks? That's the ones I'd be worried about because I swear, like every freaking person that goes on CNBC likes energy stocks. I'm not kidding you. It is ridiculous. I don't think I've seen anybody go on CNBC, whether it's a video I'm reacting to over the past couple months or whether it's just me just watching CNBC or Bloomberg or whatever. I don't think I've seen anybody talk negative about energy for the last, bit of time here, okay? That's usually a little bit of a worrisome thing when, everybody seems positive on energy stocks. I can't get anybody to say anything bad about energy. It's incredible, right? So, at the end of the day, I think it's important you understand these Wall Streeters, when they're wrong, they have to bring up their price targets, and then you have a chase. It happens in individual stocks all the time. It happens they have market, let's call it market numbers out there like she had, right? Who knows where they were at the beginning of the year? Maybe it was 4,000, maybe it was 3,950, maybe it was 4,100. But they obviously had to bring it up to 4,300. Now they're bumping up to 4,600. And that's where a lot of times you kind of get the Santa Claus rally into the end of the year because you have Wall Streeters chasing returns. You also have Wall Streeters chasing these price targets. It's a whole situation. Let's just call it that. I appreciate everybody joining me as always. Thanks so much for being here. Thanks for being subscribed, folks. Make sure you take advantage of deals out there that you see in the market. Make sure you check out my workshop. Pin comment down there. How I find 10x stocks. That should help you out tremendously. It's about a 30-minute video. Straight value in that one. And I hope you enjoy that and get a lot of value. That is pin comment. Much love and have a great day.